Hey everyone, my name's Andy. My channel's Finding Value. Today we're going to be going and diving into Twitter to see what kind of information people are sharing. I do this quite often to see what's out there, and then I give my financial opinions. I do have a different microphone that I'm using right now. I'm trying something different. The other one, I was using a bunch of filters to filter things out. Let me know if this is any better. Put it in the comment section if you guys like this microphone. If it's better or worse, let me know. So we'll dive in here. We'll take a look at what's going on, and I'm going to give you a whole bunch of my financial opinions as we go. So again, if you want to follow me at finding_finance, and if you want to join our community, it's finding-value.com. We talk a lot about market conditions, ratios, individual companies, chart patterns, all that you can basically wish for as an investor. So coming on down, we've got blast from the past, early holding ISO. This is ISO Energy. Could FUU end up being the same big winner status? Maybe. Actually, I think that is a very high possibility. ISO is an early exploration company that hit a deposit. It's done very well. It's been a very leveraged play to the uranium commodity market. And Fission 3.0 is another one that could potentially be a big winner. But what I was more interested in is this pattern here. And if you look, you can see that this thing was coming down. We put that double bottom in, and then we based here, and then we moved on higher. ISO Energy nearly flat for the week, definitely holding up, and blah, da, 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 da. Very similar pattern. This was obviously posted in 2018, and he's just commenting on Vision 3.0 having a similar pattern. Luke Roman. So this is important to understand. There's a couple of different things that drive inflation. I think that we are at a crossroads, we're at a point where everything's kind of merging together. We call it a confluence of information or a confluence of events, where we could see a supercharged commodity bull market. The drivers of the credit expansion or the money supply growth on one end, and then we've got a slowdown in the near term. That M2 money supply is going a little bit negative, and that is slowing down to some extent. But this is the setup. We could get a convergence of credit expansion from the commercial bank lending side. And then money is also created and put into the system through fiscal deficits. So those are the two drivers on the credit side. The supply side, it's all jacked up on the supply side for commodities, underinvestment, whole bunch of different commodities. And this is all kind of converging to a point. We also have, which I've talked about before, extreme valuations for commodities on the low end. So we actually have a convergence of low valuations in commodities, a underinvestment leading to an undersupply of commodities at the same time that we could potentially have massive credit expansion. That is basically the 1970s. In 1940s, it happened as well. That was the fiscal driven side. 70s was the credit loaning side. We've got a 40s and 70s time frame intermixed with the 1970s, potentially a 1970s. So early 1970, so 1970, we had peak oil in America. We very well could be coming into a peak cheap oil scenario for the world. So we've got all of these converging factors that could just be massive here. So Luke says this combo has driven an 8% U.S. fiscal deficit with 3.6% unemployment, a historically unique event because U.S. government needs high and rising equities and low rates to make their fiscal math work. Last three recessions saw deficits rise by 6%, 8%, and 10% of GDP. Recession equals 14 to 18% of GDP deficit. And what's happening here is we've got that demographic coming through where they want to buy more homes. We've got the construction employment way up there. And we're going to have to build a bunch of new homes to satisfy that that gap, that deficit. That's why unemployment is so low. We also have the problem where they raise interest rates. And when interest rates go up, money starts to shift differently in the markets. You're going to see technology slow down. You'll see layoffs in the technology sector, just like in the early 2000s. All of that stuff kind of gets kicked off, and we could get a mini recession. What they call that in the real estate cycle is a mid-cycle wobble. That is what the real estate cycle looks like. So you get this mid-cycle wobble when interest rates go up, your inventory depletes to basically nothing, and people basically look at it and say, oh, the housing market can't, these interest rates can't sustain this housing market. They make up all these narratives about why it cannot happen. This has happened, in history before in the early 60s, 70s. It's happened throughout those periods as well. The mid-cycle wobble is what I'm referring to. And we've got this unique scenario where we've got massive deficit, fiscal deficit spending, the credit expansion phase that Powell's going to try to hold down through higher interest rates, which then kills the fiscal deficit. It hurts the fiscal deficit problem, and it also hurts the revenues, the tax revenues, to sustain high interest rates. So he's so screwed. He's done. So he's going to have to choose what he wants to control and what he wants to let go. So if he wants to basically control the deficits, he's got to lower interest rates. But the problem is you can't contain inflation. You're done. Because then the credit growth on the home the home side from the demographics is going to drive credit expansion from new loans in the commercial banking system. So he's in a really difficult spot, and I don't know how he's going to resolve this outside of probably just having very high inflation for a long time. And eventually he's going to have to lower interest rates because, that's what we've done in the past, as we did in the early 2000s. And then the banking sector is probably going to throw out a bunch of crap loans, and we're going to go through that entire cycle again. And then we'll have a massive deflationary deleveraging on the back end of this. And I'm going to talk about another thing that someone brought up as well. So that's my kind of take on this, and I think he's right. And this is the pickle that the Federal Reserve is in. Coming on down, he says, the mortgage on my house is an asset, not a liability. 2.9% fixed for 30 years. Paying it off would be a silly mistake. I actually agree with him. So mine, I refinanced. Mine's 2.75% fixed for 30 years. That's what my mortgage is. And if the inflation is greater, like the real rate of inflation, if it's greater than your mortgage rate, you're actually paying back the person who lended you the money with less valuable dollars. So if you took out, I'm just going to make up a round number. If you took out $200,000 or $300,000, whatever that loan amount is, you were going to pay back less than that original purchasing power loan amount. It will be more in terms of dollars, like the total nominal value, the total nominal dollar amount will be more. But the purchasing power value you're giving back is less than what you purchased originally. So you're actually using inflation to help ease that payment. And I think that's what's going to happen in the future. I think we're going to have inflation to ease the payments of how much debt is in the system. It's also signaling that the 10-year, the 30-year, all of these interest rate markets have broken their downtrends, signaling that we are going to have a higher inflationary period. So there isn't much to really argue against. The technicals on the big picture view are on our side. In the short term, yes. Short term is like a year. In a year or two, yeah, we could move down, we could get a slowdown, but overall, I think it's going to be inflationary, and Jerome Powell's in a pickle here. And I think he's going to have to work its way out through an inflationary environment, no matter what he does. He can delay it all he wants, but all he's doing is delaying the move. We've got Grady here. He said, U.S. markets are closed today, so not much will probably happen today. So let's take the time to enjoy some promising big picture charts. Platinum is backtesting versus the S&P 500. This chart is more solid evidence that a historical asset rotation is in the making towards precious metals. I think he basically understands what's going on. He's one of few that I think has a very good handle on what is potentially coming. I also think that he's in all of the right sectors, much like I think I'm in the right sectors. Platinum is a fantastic opportunity. Platinum is cheap against silver, it's cheap against gold, it's cheap against platinum and rhodium. It is the cheapest precious metal, and we're throwing these just awesome looking charts all across the board, on ratio charts, on nominal charts, on all these different things, and it's across the entire commodity complex. Platinum could be one of the best performing assets. But again, it could be a dud. We don't know with 100% certainty, but I'm inclined to think that platinum is going to do incredibly well, and its valuations are incredibly cheap. Very good looking chart, and I do think it's going to move very much higher from where we are today. Breakout of the 15-year bullish falling wedge, and a very probable backtest in the making. So be patient. These things take a little bit of time to bottom out, and then it will be grip and rip. So here's Uselink, and I wanted to talk about this with everybody. What he says is, an inversion between the 2-year and the 10-year has always been a leading indicator to a recession. The bonds market broke down in early 2020, a 40-year-long bull run. So what if that leading indicator is no longer a guarantee? What are your thoughts? Well, I wouldn't say it's a guarantee. I think what we need to do is understand, why is the curve inverting? What is driving that yield curve inversion? And this is where I'm not going to have a solid answer here, but I can tell you what I think could potentially be the driving factor of this inverted yield curve. So historically, what would happen is the yield curve a lot of the times the yield curve would invert due to inflationary pressures. And those inflationary pressures would put pressure onto the bond market for bonds to sell off. So then they would sell off sometimes in a sharp fashion, and the yield curve on the short end would go up at a faster pace than the long end, inverting the 2 and 10-year duration yields of those 2 and 10 years. And they would invert where the 2-year yield would be paying higher than the 10-year yield. So that would be an indication generally of where you're at in the real estate cycle. Because the real estate cycle, most of the time, is what drives this, almost all the time. And what happens is the real estate cycle kicks off it gets heated up. You get a little bit more new home builds out there. You get more loans, more credit expansion in the commercial bank system. And that inflation that comes into the system puts the 2 and 10-year bond market into an inversion a lot of the time. And it inverts because of the inflation from the credit expansion in the system. So when that inverts, that is indicating where you are in the cycle. And generally, after that inverts, we get a crash because that is where we are in the real estate market. Now, I don't think we're that far into this real estate market. We're in the mid-cycle wobble. In the mid-cycle wobble, what you have is you've got low inventory numbers. So your inventories are incredibly low, and you've got your home builds are starting to kick up. This market that we are going through right now is unique, and I will describe why I think it's unique. It's unique because they threw a bunch of stimulus money into the system in 2020, which could arguably be the driver of that inflation. Now, the question is, did that inflation that they used with the stimulus money, and I know we had some commercial bank lending also occur in the real estate market, because what they did is they lowered interest rates, and we are in the middle of a strong cycle. And that is evidence by the housing market going up as much as it did. That is evidence of us being in the middle of that strong cycle and low inventory. So what happened was we raised the interest rates at a very fast pace, quicker than history. And we may have raised rates too quickly. We may have. And that could have been driven by the stimulus money in the system being a large portion of the driver of it. If that's the case, that is not a sustainable inflation rate. So the rates could come back to a level that is more sustainable by the market. And the sustainability of the market is from the real estate market. That is where the inflation is the driver from. That is naturally, organically happening in the markets. It's not stimulus driven. That is a fake kind of one-time press the pedal move. So that is where I don't think anyone knows the exact answer there, because if you were to look and say, well, what is the leading cause? You could say, well, a large portion of the leading cause is stimulus money, and another large portion is all the loaning that happened in the real estate market. We didn't go into a really large, big boom in the real estate market in terms of new housing starts. So I don't think that that's mainly the driver. I think it was a big stimulus-driven utopia, orgy type deal that happened. So what we need to do is, the inversion is from that. We could get a slowdown. We could get a recession. It is all possible in this mid-cycle wobble of real estate. And when we pull on back, we could get a slowdown like the 2001 tech type slowdown. Now, the question is, when is it going to end? It may have already ended. We don't know that for sure. And we need to see, and I'm not going to get worried about this potential recession, because the real estate market is looking very strong in terms of inventory numbers. The question is, are rates too high? Because it was driven by stimulus and the real estate market. It's not organic. It didn't move here naturally. And that's where no one knows that answer. But I think I described it properly to what I think the leading driver is. Coming on down, it says U.S. markets are closed today, so not much will probably happen today. So let's take time to enjoy, again, big picture charts. Orange backtest holding for oil, searching for 3-year cycle low. We'll see at least $250 to $300 during this bull market. Go Grady. At least I've got another person in my camp that is up in the multiple hundreds of dollars for oil in a potential oil squeeze. You can see a large shoulder that dipped down into no man's land. We've come back up. We've broken the downtrend line. This is logarithmic. We've come back. We're at the 50% retracement level. Now, it's possible that we get a one last flush out move down to 61.8 if we get this recession, slowdown, worry, whatever it is. It's also possible that we don't get it and it starts to rip on higher. The fact that nobody knows the future and the fact that we don't have a real estate crash behind us, that makes it a lot more difficult to try to predict a recession. I don't think anyone can predict a recession. I think you're going to hear a lot of people say it's going to happen next month for maybe 5 years straight. And then it happens 5 years from now because the real estate market pukes on itself. Because of a hyper supply phase, foreclosures, and all those other things. But that is where we're at, and this chart looks fantastic from a backtest perspective. That is generally where I buy. So do you throw away your general kind of strategies? No, I'm not. I'm going to continue to buy. If it's down and it's cheap, it's down and it's cheap. The oil to gold ratio is upper 20s. Historically, that is incredibly cheap and a very good time, statistically speaking, to purchase oil and to cost average in. But that's where we're at, and we haven't bottomed yet. You can kind of see the MACD hasn't bottomed yet. I don't really use that as a overall factor, but stochastics are also starting to come around. Again, I don't really use these. I like Michael Oliver's wet noodle indicators, but it's going to turn around at some point, but we could get a flush down, one last flush out, where we could go down a little bit more. It'd be a false breakout and then a slingshot higher, slingshot cheetah that I always talk about. It could happen. Another one from Grady. uranium is just getting started, even though URNM moved 580% in its baby bull move. Now up against the purple bull flag breakout line again. So we've got reverse symmetry patterns. What that means is you cut this in half. The way that this thing has fallen, the stock or ratio has fallen, often moves up in the same fashion because you'll have the same resistance and support levels over time. So you're going to have a lot of resistance at certain levels, then you come back to another support level, and then you rip it. This here is uranium versus the Sprott Physical Uranium Trust. It's basically the equities ratio, and it's stating that the equities are incredibly cheap. We know that. We've gone over that quite a bit. Uselink and I have talked about it before, and we know that uranium equities are incredibly cheap. The play here, in my opinion, isn't trying to time the short term. The play is to play the big move. Why play the big move? There's no opportunity cost if you sit in something, even if it goes sideways for a year, but the overall payout when you're right is 20 or 30 to 1. Because I don't know too many people that are making those types of gains. It's possible to beat some of the best investors by adopting some of these techniques. Someone asked me, what's my total return since 2020? It's 700% from the bottom of 2020. And that's when I really fully adopted everything that I'm basically showing you guys. I did other things, but I've been waiting for this bull market to come. I was over before that. I had very good returns, but I was over in technology. I was in Roku. I was in the Trade Desk. I was in Baidu, Google, some of those types of companies. Visa, MasterCard, United Health Group, all those types. But now more commodity focused because that's where the opportunities are. And he says, this chart shows that uranium miners have not yet even begun to outperform the uranium price, which is what makes a bull market. A very stylish and bullish chart. I like how you use stylish. Yeah, it looks really good. I will say that. Coming on down, we got Brady again. He says, getting out of the USD was a good idea. Also called the top in March 2020. Currencies produce amazing technical analysis now, which is included in the weekend report at his service. We've got UUP, which is basically the bullish index dollar, and this could head lower. This is a shoulder, head, shoulder potentially forming with the neckline. It's a reverse symmetry move down coming potentially, and we're in the upper portion of this slanting upward channel. We could head down back to the lower end of that channel over time. And it's going to be a tailwind to our commodities if the dollar weakens against other currencies. And we've seen that on the third leg of a lot of these bull markets in history. We've seen a weaker DXY. So what happens is inflation comes into the system. We get this inflation that comes into the system. They jack up interest rates, and that's what strengthens the dollar a lot of the times, is the increase in interest rates at a faster pace than other currencies are increasing their interest rates. So that we get the increase in the interest rates, then they pause. If this is a mid-cycle wobble, what you're going to see is you could see a pause. They could lower rates because the overall financial markets start to puke on themselves, which is going to add to the driving factor of more inflation from the real estate market. Because when they lower the interest rates, it's going to add fuel to the affordability of homes. That's going to shoot on up, and then the dollar will go down because they're lowering rates or holding rates, and other currencies could be strengthening. Another thing that could also happen is other currencies start to, we'll say their housing markets aren't as strong. So they kind of crumble before the United States do. And then you'll have weaker credit expansion in those countries versus our country. And we would see a weaker dollar in relationship to those other currencies because they're having problems with credit expansion. They are basically having deflation, which is stronger currencies than their currencies, potentially. Coming down, Doom Porn, it says, no one can buy a home Redfin, hold my beer. 1/3 of home purchases were made in cash in April, up from 30.7% a year ago and comparable with February's level, which is the highest it's been in 9 years, according to real estate brokerage Redfin. So we got to hold my beer. I talked with Casper. We've got Rick here. So uranium and oil stand to benefit greatly here. Look at the 1929 and 1969. What happened following these periods? Next several years, where will the money flow? World is desperate for these commodities. Again, I've talked about this before. The period where commodities are cheap, you would have just made out like a bandit if you purchased in these areas. The one thing that was negative about this period is it stayed very low for a long time. So you had to kind of grind this thing out as it started to move. But I think that the market conditions are ripe for this to turn higher and move and outperform. Someone also commented, they asked me, maybe precious metals may not be as big of a benefactor now that we've got Bitcoin. And then his question was, what do I think about Bitcoin and the potential of Bitcoin with this commodity bull market that's coming? I'll be honest, guys, I don't know how Bitcoin is necessarily going to perform. It's got a very short history. So you're really rolling the dice there. And if it is a speculative technology stock, if it trades like a speculative technology stock, which to me, it looks like it correlates very well with the NASDAQ and the tech stocks. If that is the case, we could see a big crash in Bitcoin if the tech stocks eat it. And I don't know necessarily, the value of Bitcoin is questionable. I don't think it has any value. I mean, that's really my opinion there. And obviously you can debate that. I'm not here to try and debate that, and I'm just going to have my opinion on it. But I don't know that value yet. And I'm going to say that since I don't know the value and it doesn't have history and I don't have any of that stuff, it's too speculative for me to really allocate any money to. And I don't really see it as an asset. I see it as nothing. That's just the way I see it. So I don't want to get too deep into it, but that's kind of where I'm at with that. So let me say it again. The Fed broke Cosmo. I already went over that once before. So that's what we've got for today, guys. I'm going to end it there. And I'm not I don't really care about Bitcoin. When I think of, if I were to wipe Bitcoin off the face of the earth, nothing's going to change. If you wipe silver off the face of the earth, if you wipe oil off the face of the earth, nothing gets done. Things stop. We can't have this conversation. There's a lot of things that are dependent on those materials. So I can see the value in those things. What you're doing with Bitcoin is you're really going out on a limb and saying that people will adopt it. And the value comes from the adoption. So you're basically stating that Bitcoin will potentially be something that people will adopt in ever increasing amounts. I just don't know if that's a true statement. That's where I'm at. But that's what I've got for today, guys. If you guys enjoyed the content, give me a thumbs up, subscribe to the channel, and we'll catch you next time. This is Finding Value.